It's good to be back looking at markets afresh after a holiday break. The last time I've covered a lot of sentiment indicators, so that's not what I'm going to touch upon. What I'm going to do is try and answer the question as to when we start setting higher targets for the market rather than look for a correction, because I get a lot of questions on what about more upside, are we headed to people who are already claiming 6800, feeling that they've missed out on a bull market. I've definitely missed a couple of 100 points on the Nifty since the high of 6142 in September, where I wrote that we should be headed down, and we did for a couple of days. And we've gone around 200 points above that and fallen off today. So, what is it? At what point do we actually start setting targets? I'm going to just highlight something more basic that I look at, which is look at the momentum cycles of the market. Now, this is an indicator based on the rate of change moving above and below the zero line. Now, the objective of showing this is that if you're using any indicator, it will spend time diverging from prices and then go to the other side when the trend is up, and then when the trend is down, the trend is up again, and when the trend is down again. The very important part about this is that at what time do you actually set a target? The time that you actually set a target is only after a particular cycle of one trend is complete and another trend takes place, which means that after you have had a downtrend here and you get a counter trend cycle, at that point of time you're able to set a target, which I did way back when in August we got this decline. I said A equal to C would be close to around 54.30, and we got that target. And moment we came close to that around 54.80, I started looking for an upward move. After a couple of days, we did see lower levels stretching, bouncing back, stretching, but there were enough divergences to keep looking for a bottom, which eventually did come, and you got a very powerful bounce back. So, but at that point, to set that target of 5400, I waited for a counter trend move to happen. Now, sometimes markets can stretch without giving you that move, which is what has happened here. Once you got the first 5-wave move up on the Nifty, I thought that was sufficient. The question that I get is, and in fact some people have already done, is simply added this up and started targeting up here, which comes close to around 6800, something that I would not do yet, simply for the reason that we've had an up cycle, but we really have not had a down cycle. Until you get that correction, whenever it happens, you really don't know whether this is the beginning, whether this is the start of a fresh move. What I mean by that is, if I mark this 1-2, is this entire move part of a third wave? This is something that I cannot be sure of when cycles are incomplete, and therefore I like to see that happen before simply adding numbers up. And so till that point of time, even if I'm missing a move in the market, I'd rather just wait for the market to give me an opportunity to reassess the situation when I've gone wrong. So right now this has been a waiting period. Today the momentum indicator that has been whipsawing again and again after this first cycle, giving a sell indication here, which I tried to look upon, and then the high got taken out last week, and we again today have seen a downward move that has led to another sell indication at the end of what I'm calling a larger 5-wave advance. Even though it's overlapping, each of the up moves look like 5, and so it has the look of a leading structure, an overlapping 5-wave structure, typically seen at the start of moves, but in very rare occasions it could be part of C. So like I said, even if it's a leading structure, you will need a correction before you really can target more upside, and therefore this is the discipline that you need to really wait for. To simply give you an example of this, going really back in time into a period that was more bull marketish, here we have a period of positive momentum, even though we had a very minor correction. At that point, once you've actually completed that cycle and seen some downside, it becomes possible to actually project an equal and significant upside. This kind of behavior is still not been seen in the recent market, and so I'd simply want to wait for that to be complete. And if I go by my preferred wave count, which I've already discussed in the weekly update, then for all you know, this 5-wave rather than a beginning is the end of something. So the next move down would give us more clues. Today we already are seeing some initial minor legs on this hourly chart, which I can actually classify as waves 1 and 2, and we've started the third. The first most important support is going to be the C2 C4 line, which it's slowly moving up. I've written the reversal at 61.70 in the morning, 61.60 yesterday, and it's moved up to around 61.80. And closing and staying below this line would be an indication that you're getting a larger correction to this overall trend. The next important support level would be the 40-day average, which comes closer to the 6032 level. So after you break this rising trend line, you'd look at the 20 DMA 6167. So again, I think 6180, 6160 to 6160 to 6180 should be an important support zone out here. And once that breaks, then we are looking at going down to around 6032. That would be the next level where you would consider as to whether this entire trend has corrected sufficiently and it moves up. If you actually have a three-wave decline, we would start doubting the bearish case. However, if you do see a five-wave decline at that point, then we would start expecting a further downward development. So we'll be watching those levels for this move. I think from today the short-term trend would be down till we get an indication of an uptrend once again. The 6342 high that we made yesterday or day before yesterday would actually be the reversal level for the move down, and the potential would be to target 6160 and 6032 in the short term, and then see whether those levels can break based on the wave structure that develops up to that point. And it's only after we've seen that correction, if it is three waves, would I be comfortable in actually moving this box right up and then targeting higher levels. But unless we see that, I don't think that's the right thing to do, because you have incomplete cycles and a lot of sentiment indicators that are simply stretching or diverging against the market, that at some point can cause a severe reaction, and that makes the whole move extremely risky even now. So what I've essentially showed you today is how to actually use these indicators to allow you not to get perturbed if certain moves are missed. It's really not possible that everyone captures each and every move. If you can capture a handful of moves in the market from time to time, they are sufficient to really manage your trades and return you positive returns from those trades. There are going to be moves that you will miss out on, and then you have to wait for things to fall in place to really take the next trade, rather than just jump in out of sheer anxiety. So this is how I look at these indicators, wait for them to actually complete cycles to take a view as to what is happening. If something is missed, we simply look for alternate structures that may be developing, and you need to of course have a money management system in place to manage your trades, something that I've been wanting to do in terms of a video as to position sizing and trade management, and I hope to cover that in one of the future sessions. So thank you. That's all in this update for today with the new year starting.